David, it's good to talk to you today. Thanks for joining us.
Thank you.
Trade war is escalating. There's no doubt about that. Where does it leave us?
I think it leaves us in this bog of uncertainty, and it's very difficult, I think, to justify valuations of the stock market that are above historical norms in the context of this trade war, economic war with China entering into a whole new chapter. I think that's the story right now, is a re-rating of risk.
Yeah. How big of a risk do you think that is, that what we've had is a trade war now becomes with a currency cocktail mixed in?
Well, I think that you got a bunch of things. We went into the year with a lot of hope to cause this multiple-driven rally. We thought there'd be a trade deal with China. That's not happening. We thought we'd get a smooth Brexit. That's not happening. Sarah mentioned earlier about the Powell pivot. Well, with all deference, that was 7 months ago. If anything, this sell-off started early last week and actually continued into Wednesday and Thursday because the Fed bungled its communications. I mean, that was what you call a hawkish cut last week at the Fed meeting. So the Fed, again, bungled its communication skills yet again. So this confluence of factors, and then what's happening in Hong Kong right now, the trade war between Japan and between South Korea. I mean, you're getting this sense right now for the first time the stock market is seeing what I've been seeing, which is a global economy that's really starting to splinter apart.
And we're also starting to see the data turn, David, I think importantly. I mean, today's ISM non-manufacturing was lower than expected. There were pockets in the jobs report. I know you've been talking about this stuff for a while. So when you see the 10-year, U.S. 10-year 174, how much weakness is reflected there, and how low could we be going? Are we going to be talking about negative rates in this country?
Well, I'll tell you, the charts don't lie, and there's just dead air between where we are now in the 10-year note all the way down to 135, where we were back just after Brexit in 2016. And when you look at U.S. bond yields in conjunction with where they are globally, the U.S. Treasury market is the tall man standing. I'm looking right now at three other things. Inversion of yield curves in three big countries. The U.S., Germany, and Japan is back to inversion with negative rates. Those are three of the four biggest economies on the planet. And it's telling you that the risks of a global recession, and of course that's being embedded in the price of copper too, those recession risks globally, not just in the U.S., are rising inexorably right now. And this, not just what happened between Trump and the unexpected 10% tariff on China, but nobody really expected that China was going to retaliate this quickly.
David Rosenberg, thanks for phoning in.